Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 52, we're going to have a little bit of a follow-up on our content from episode 50, and we're going to look at a situation where a charity is the designated beneficiary of an IRA, and procedurally how the personal representative of an estate would follow that based on guidance in a 2019 IRS private letter ruling. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, when it comes to non-individual IRA beneficiaries, the rules are pretty well established that the IRA must be paid out to that entity beneficiary within 5 years generally of the IRA owner's death. Now, usually an IRA, if an individual is a beneficiary, could potentially be stretched out for up to 10 years or maybe even for the individual's life under the recent Secure Act changes. So by shrinking this to a 5-year period, it reduces tax deferral and it could prematurely tax the entity beneficiary at a more rapid rate or frequent rate than you'd see with a longer stretched out IRA distribution to an individual beneficiary. But what if a charity is a beneficiary? Well, that's the real question in today's discussion, and you're still going to have the 5-year rule generally with respect to the charity, so the stretch will be lost. However, since the charitable organization is or should be tax exempt, the IRA distribution to the charity at the end of year 5 would be of no consequence. So the big question is, how would this IRA be administered procedurally? Now, in Private Letter Ruling 2019-43020, the IRS kind of clarified the procedures that apply here when an account owner dies and where a charity is a beneficiary. So we're going to look at two questions and two approaches here. Should the personal representative of the estate, 1, liquidate the IRA, incur tax to the estate, and then distribute the cash proceeds to the charity? The answer is no. Mainly, the personal representative doesn't have any authority to liquidate the IRA if the estate itself is not the beneficiary. So number 1 is not an option. Instead, what the personal representative has to do is make a trustee-to-trustee transfer to a new IRA in the name of the owner for the benefit of the charity while not recognizing income. Now, what this private letter ruling made clear is that you can have an IRA for the benefit of or in the name of a charity. You don't have to necessarily force every single IRA to either be a rollover IRA or an inherited IRA after death. And if you don't shoehorn into one of those classifications, you aren't forced to liquidate the IRA and recognize income. Now, it's important to note here that since the estate is not the beneficiary, there'd be no income tax deduction for the estate. But there is an estate tax deduction. Now, if the estate itself had been a beneficiary of the IRA, this result could have been different. In that case, there could have been maybe a pecuniary bequest to a charity under the estate plan, and if the personal representative or trustee chose to use the IRA or an IRA distribution to fulfill this bequest, then there could have been income tax liability to the estate, either as the distribution taken as a withdrawal of cash to satisfy that pecuniary bequest, or in the use of an IRA maybe as a rollover or drop-down distribution to the charity in fulfillment of a pecuniary bequest, the latter being an acceleration of income in respect of a decedent, or IRD. Now, if you want to benefit a charity during life, using your IRA, there's a couple options you have as an account owner that largely depend on what your age is. One option is that you could take a distribution from the IRA, be taxed on it, then give that cash to the charity with the expectation of a back-end income tax deduction, or you could make a qualified charitable distribution, or you could do both. So, there's a couple limitations around a qualified charitable distribution, or QCD, that you should know. One is that it's capped at $100,000 per year, and that it doesn't grant an income tax deduction. The tax benefit you get from that is that it satisfies your required minimum distribution amount for the year. So if you're supposed to take an 80,000 RMD for the year and you make an 80,000 qualified charitable distribution, then you won't have to take any additional money out of the IRA personally for the year. But because of that RMD requirement, that means you have to have reached your required beginning date, April 1 of the year following the year of your 72nd birthday, to get that tax benefit. So before your required beginning date, you still have to use that manual path of making a distribution to yourself and then using that cash to go to the charity and get a back-end charitable deduction. But you should note a couple pieces on that. One is that there's an AGI limitation to that, and the second is that you have to itemize your deductions to be able to take that charitable distribution deduction to begin with. Now, if you're reporting a qualified charitable distribution on your 1040, the way you handle this is that you'd include the full distributions for the year on line 4A, and then in 4B, the taxable amount, you would subtract the amount of the QCD from that. And then you'd write QCD next to the line. So in this case, if we had a $100,000 distribution and it was fully a qualified charitable distribution, we'd just enter 0 as the taxable amount and write QCD next to that. Thanks again for joining this episode of the 10th of an Hour. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening, and I look forward to seeing you in the next episode.